you're making the same stupid mistakes in trading. And how do I know that? Because my name's Nick Sean, and I've been trading for 6 years, and I probably made all these mistakes that you're making as well. I'm going to cover 3 of the biggest mistakes you're probably making, and I'm going to show you how to solve them. Let's go ahead and just get right into it. So, number 1, you haven't clearly defined what you're trying to do. You don't have a clear trading system that you've actually written down the rules for. You don't have a set of criteria that you follow for pretty much every single trade to help show you when to enter and exit. You're just looking at the chart. You're trying to decide if you think it's going to go up or down. You have no systematic structure to follow. Number 2, the biggest mistake you're probably making is you're too damn impatient. You may have a set of trading criteria and you know what to wait for, but you don't wait for it. You let your emotions and fear and greed and all sorts of things take you over, and it makes you make really stupid, dumb decisions on the chart. I'm going to teach you how to solve this. Number 3, you don't have a consistent method of controlling risk. You can be a high-risk aggressive trader. You can be a low-risk conservative trader. You can be a medium-risk kind of guy, kind of like I am. I spread my risk out between multiple assets, multiple accounts, and multiple markets. But whatever approach you have to have a consistent method of controlling risk. And if you do these 3 things, then you have a lot better chance of getting profitable. So now you can click away from the video. You know what the 3 things are. If you want to stay and watch, then I'm going to show you all these things in more detail. You're making some pretty stupid mistakes in trading, so let's solve them. So number 1, you don't have a clearly defined thing of what you're trying to do. So a lot of people, this is how their trading will work. They'll look at a chart and they'll say, I think it's going to go up or down. So they'll buy or they'll sell. And then when the trade goes into profit, they don't know where they're going to get out. If the trade goes into a loss, they don't know when they're going to get out. They don't know how to calculate the correct position size or the amount of volume they're going to be using. And so you end up going into all this like crazy stuff and all of this confusing, complex method of trading that doesn't even have a clear structure and doesn't even have a clear outcome. Here's how you can fix that. You form a simple trading system. So I'll give an example. You could have a trading system where it's like a trend-based system. It can have 3 rules. The first rule could be, find a clear trend to make sure the market's going up or down, higher highs or lower lows. Number 2 could be wait for a pullback during that trend. And then number 3 could be wait for price to start continuing back in the original trend direction before entering. And the 4th rule could be, method of risk management. Risk, 1% of your account, 5% of your account, whatever it is you want to be. And then target a 1-to-1 risk reward. So you could do like a 5% risk. We'll say, for example, if you're trading high risk on a small account, 5% risk for maybe like a 1-to-1 risk reward ratio. What would this look like on the chart? Let's actually look at a clear example. So price is pushing up. You have a clear uptrend, higher highs and higher lows. It's very simple. You don't need any indicators. You don't need moving averages. You don't need anything crazy. All you need to do is price making higher highs and higher lows. That's the first rule. Second rule is a pullback. Okay, so price pushed up and then had a pullback. All right, so now what do? We'll wait for the market to continue back in the original direction. So after the market pulls back and then it starts to bounce up, you can enter a buy, for example, right here. It pulls back, starts to kind of continue back up. So you enter a buy. You have a stop loss maybe below the previous low and then a target maybe at the previous high for around like a 1-to-1 risk reward ratio. And then you just let the trade play out. You can also, you can experiment with tighter stop losses, bigger targets, things like that. The idea is to keep it simple when you start and you can optimize it as you go forward. So you need to have a set of clearly defined rules for what you're trying to do. And that's probably the first mistake you're making in trading if you're not doing that. Second thing, you're too damn impatient. Let's say for this system, right? It's a simple trend trading system. Price moves up, and then it pulls back, then it moves up and it pulls back, and it keeps doing this over and over until the trend ends. And you're supposed to be waiting on a pullback before entering. So for example, you're trading, Bitcoin is pushing up like crazy. It's going crazy. And you know that where the trend area is like, somewhere down in here. And so you're waiting for a pullback. And so you know that if price pulls back this far and then it starts to bounce up, it's probably going to be a good trade worth taking. Get a reasonable risk to reward ratio, good entry, things like that. But then what you do is you get impatient. You see Bitcoin start doing this. It pulls back and then it starts going up here without having like a nice pullback first. It's almost still in like its push phase. And so instead of just being patient and waiting for what you know is more likely to happen, which is just a deeper pullback and then rejection, because then you have better risk reward, everything just works out better. You get impatient, you enter up here. Then you put a stop like right there, and then a target of 1-to-1 like this, or whatever your target is. And then you start getting nervous whenever it starts not going in your favor. And then it starts pushing back, pushes into profit. This one would have ended up working out. But let's say, for example, you were really going for a higher high and then you had like a tighter stop loss or something. Instead of waiting for a better entry, you enter really early, and then price ends up screwing up on you, and then you get upset that you didn't just wait for the original trade that you wanted to take in the first place. It's like, for instance, like a better trade would be like right now what Bitcoin is doing. A better trade would just be like price pulls back and then starts to bounce and then entering like right there on the bounce. So this way, for example, when price starts going up here, you can have like your stop still underneath like the structure low of where the trend is at. The structure low is just the previous low that was formed before price went and made a higher high. So like, essentially somewhere down here. So you have your stop below that area, target it like a 1-to-1, which is essentially the previous high. You know that this, if the trend continues, this is less likely to stop out. It's more likely to hit your profit target, and you're less likely to be stressed and see drawdown. And you know how you do this? You just be more patient. And how do you be more patient? You have a set of trading criteria, and you do not take the trade unless that trading criteria sets up. It's okay to use a little bit of personal judgment, intuition, discretion in your trading, but the only way you develop that is through getting experience, having the same trading system to see what consistently happens over and over. Then you can start using your own little bit of subjective opinion to kind of use trade selection. That's okay, but it all starts with having a clearly defined trading system and then waiting patiently for those trading opportunities to set up. The final thing, number 3, is you don't have a consistent method of controlling risk. There's no reason for you to take one trade, for example, right here, that has 50% account risk, and then that stops out, you lose 50% of your account. And then all of a sudden right here, you take a buy right here, but you only had 5% risk. And let's just say, for example, you had like a 1-to-1 risk reward ratio, and now you make 5% profit. So you've lost 50% on this trade, now you have 5% profit. It's not a very consistent method of controlling risk. There's different ways of controlling risk. You can control risk using stop loss orders. You can control risk by using small position sizes and scaling in at better prices. You can use a method of controlling risk, which is risking a set amount for a first trade, maybe 1%, 2%, 3%. And then if that trade goes into profit, you can move the stop loss to break even and then enter another position with its own stop loss, which is like 1%, 2%, 3% risk. You can keep adding into a winning position. You can hedge. You can enter buy and sell orders at the same time if price doesn't go where you initially thought it would. You can scale in. There's all sorts of things you can do to control risk. I teach all of this here on my YouTube videos, as well as more comprehensively in my compounding course, as well as my full program. It's a full mentorship program linked below in the description. But essentially, you have to figure out a way of controlling risk, and you apply that to your trading system. Okay, so let's recap these 3 things real quick, so that way you can get on with your day. The first thing is that you need to have a clear trading system that's clearly defined. You need to clearly define what you're trying to do. If you're not doing that, you're making a mistake. Number 2, you're too damn impatient. You're not waiting for what your system is actually dictating. If you wait for what your system criteria actually says you should do before entering a trade, you're going to have more consistent data, a more consistent workflow, and you're going to get better data and better experience that can generate some intuition to kind of help you in the future as to what you should do. So you need to be more patient. And number 3, finally, you don't have a consistent method of controlling risk. It's okay to be a low risk trader, a high risk trader, a medium risk trader, whatever you would call that. But you have to have a consistent method of doing it. That way you can get the same consistent results. If you want to trade high risk on one account that's small and then trade low risk on a larger account, with smaller risk, that way to protect the account capital, that's okay. You just have to figure out what your method of controlling risk is and make sure it's the same in a systematic approach. With that being said, I'd like you to invite me into your home and let me and my team try to help you. I'm just kidding. You don't have to invite me into your home. But if you would like more information about how my team and I can actually help you do this and work with you one-on-one to create and test and optimize your own trading system, check out the Mission FX full program linked below. It's a full mentorship program conducted by me and my team. You can apply for that program, and then if you're a good fit, my team will reach out to you to book an onboarding call. If you're just looking for a simple trading system that teaches all of this stuff step by step, and you already have some experience trading, the compounding course would be better for you. You can check that out in the description below. And with that being said, if you enjoyed this video, you don't have to hit the like button, but just make sure to go and have a cup of tea and watch the sunset while you plan your good trading habits. Hope this video was useful to you. See you in the next one.